In the high-stakes world of Forex trading, there exists a single monthly event that can shake the very foundation of the market. This event is known as the Non-Farm Payrolls, or NFP. Today, we embark on an epic journey to uncover its secrets, reveal how it empowers traders, and demonstrate the strategies that can turn volatility into opportunity. Each first Friday of the month, the U.S. Bureau of Labor Statistics unleashes the NFP report, a critical snapshot of the nation's employment landscape. Excluding farm work, government, and private household roles, the report reveals the net change in private sector jobs. This number is more than just data. It's a pulse check of the American economy, dictating the rhythm of financial markets worldwide. When the NFP report hits, the Forex market ignites. The US dollar surges or stumbles in response to the strength or weakness of the job market. Traders across the globe brace themselves for a maelstrom of volatility. A stronger than expected NFP number can signal robust economic growth, setting the stage for potential interest rate hikes. The result? A bullish US dollar. Conversely, a disappointing NFP release can trigger doubts, sending the dollar into a tailspin. For traders, the NFP report is both a beacon and a battleground. Its volatility creates profit-making opportunities for those who are prepared. But with great power comes great risk. To harness the potential of the NFP, traders must be armed with robust strategies and unwavering discipline. Why do traders focus on these events or indicator? 1. Predictable timing. The scheduled release dates allow traders to prepare strategies in advance. 2. Liquidity. These events increase trading volume and liquidity, making it easier to enter and exit positions. 3. Volatility opportunities. Large price swings offer significant profit potential for experienced traders. 4. Macro insights. These indicators provide a big-picture view of economic trends, helping traders align their positions with long-term fundamentals. Let's dive deep into the strategies that can transform NFP volatility into a trader's ally. 1. The Straddle strategy. 2. Fade the move. 3. Price action and fundamentals. Moving on, the Straddle strategy. Before the NFP release, experienced traders place pending orders both above and below the current price. As the market breaks out in either direction, one of these orders is triggered, allowing traders to capture significant momentum. In this example, the market is generally in an uptrend and currently in a short-term retracement to an order block. However, we don't know whether the market will continue its bullish run or break that key level. Liquidate buyers, change character, and continue selling. A few minutes before the NFP release, we place a buy stop a few pips above the current price level and a sell stop a few pips below it. Due to high market volatility during these hours, we simply wait to get triggered in whichever direction the market chooses to go. In this case, our buy stop got triggered. When trading news events, don't be greedy. A 1-to-3 or 1-to-4 risk-to-reward ratio is sufficient. Then, close your laptop and leave the charts. Note, always set tight stop-loss orders to manage risk in this high volatility environment, as the market can sometimes trigger both pending orders. Let's look at a real chart example. Here on the EUR/USD 1-hour time frame, the market is in a downtrend, but currently at a support level. Since we don't know which direction price will move during the NFP news, which is just a few minutes away, we quickly mark out key levels a few pips away from the current price for our pending orders. We place a buy stop above the current price level and a sell stop below it, letting the news dictate the market's direction. Set your take profit according to your risk tolerance. You don't have to be greedy and risk losing your capital when trading news. Our sell stop got triggered and take profit was hit. Note, it's not always this simple. Only trade news with capital you're willing to risk if you lack experience in trading news events. Before we continue, don't forget to subscribe and like so we can keep creating informative videos such as this. Thank you. Moving on. 2. Fade the move. Sometimes the initial reaction is an overreaction. Traders who adopt the fade strategy wait for the storm to settle, then position themselves against the prevailing move. They bet on the market correcting itself once the initial panic or euphoria subsides. After the news release, if the market starts losing momentum, printing smaller or indecisive candles, drop down to a lower time frame, such as the 5-minute chart. Look for a change of character to counter-trade the already exhausted market. However, this requires skill. Ensure you backtest multiple times before attempting it on a live account. Let's look at another example on a live chart. On EUR/USD, after the news release, the market started printing indecision candles, signaling exhaustion. We then switched to the 5-minute time frame to look for an opportunity to counter-trade the move. The market is still in a downtrend but now consolidating, so we wait for a clear change of character before entering a buy trade. Eventually, the market created a lower low, followed by a higher low. Our key confirmation is when the price takes out the high of the move that formed the last low, which it eventually does. For entry, we place a buy limit at the most recent order block. Since volatility is still high, price is unlikely to retrace all the way to the extreme order block. Our stop loss is set below the lowest point of the move, as long as it fits within our risk management plan. Take profit is placed a few pips before the next key level. However, after evaluating our risk-to-reward ratio, we find that it does not align with our plan, so we adjust our risk accordingly and let the market play out. Note, risk management is more important than potential profit. Always protect your capital by risking wisely. Eventually, take profit was reached. Moving on. 3. Price action and fundamentals. By analyzing key levels, liquidity grabs, and post-NFP price action patterns like fake-outs, break-and retests, and engulfing candles, traders can transform NFP volatility into high-probability trade opportunities while managing risk effectively. While price action helps traders react to NFP volatility, combining it with fundamental analysis can provide an early bias on whether the report might be positive or negative. Here's how traders can anticipate the results before the release by watching out for these key fundamental indicators. 1. ADP non-farm employment change. A positive ADP report suggests strong job growth, hinting at a bullish NFP. Number 2. Unemployment claims. A rising number of jobless claims signals weakening employment conditions, increasing the likelihood of a weak NFP. 3. ISM manufacturing and services PMI employment components. If businesses report hiring increases, NFP may be positive. If hiring slows, NFP may disappoint. 4. Consumer spending and retail sales. Strong consumer spending often correlates with job growth, hinting at a positive NFP. Vice versa. And these data points can be found on investing.com. Moving on. On this example, let's assume the ADP report was negative. Unemployment claims are rising. Manufacturing and services PMI indicates slow hiring. Based on these factors, we anticipate a weak NFP, which could negatively impact the US dollar. Note, if trading a pair like EUR/USD, where EUR is the base currency and USD is the quote currency, a weaker USD would cause EUR/USD to rise. Conversely, if trading USJPY, where USD is the base currency, a weaker USD would result in USD/JPY going bearish. Applying price action. So in this example with EUR/USD, since we expect EUR/USD to rise, we only look for buying opportunities. We identify an order block several pips below the current market price, anticipating that the market might sell off first, triggering stop losses before rallying. So we set a buy limit at the order block and let the market play out. Let's look at another example on a live chart. On EUR/USD 1-hour time frame, the market is bearish and we expect a positive NFP, meaning we're only looking for sell opportunities. For this trade, we use the flip zone strategy. 1. We mark out demand zones that previously caused price reactions. 2. Identify flip zones, where previous demand levels have turned into resistance. If you don't know how to identify flip zones, I will suggest you check our previous video on flip zones before coming back to this for better understanding. In this case, flip zone 2 is still unmitigated, so still active for business, but flip zone 1 has already been mitigated and wasn't respected, serving as an inducement and liquidity to zone 2, therefore increasing the probability of price respecting zone 2. On a closer look, market also moved in a trend of higher lows, and whenever I see this in a downtrend, I expect price to go all the way through the range of trendline when it breaks. So we set a sell limit at the flip zone, where we expect price to react from and target the base of the trendline as take profit, and eventually we got triggered and take profit reached. Note, it's not always this simple. It takes a lot of practice to trade news in different conditions, so make sure to practice repeatedly before going live. The non-farm payrolls report is more than just a monthly statistic. It's a catalyst that shapes global markets and creates opportunities for those who dare to master it. By understanding its impact, employing strategic trades, and rigorously managing risk, you can harness the power of NFP to elevate your Forex trading game to legendary heights. Happy trading from DMFX Trading School, and thank you for subscribing. See you next time.